At some point, you reach a savings target, and then you say, well, why don't I go another notch up and another notch up and another notch? Is that one more year syndrome, obviously? So I did that for a few years, right? Especially if you work in finance, right? You can make very good money. And then you get your year-end bonus, which is usually paid out early during the calendar year. And so you get that one bonus, and then you ask yourself, should I retire? No, oh no, let's do one more year. And let's get another one of these big paychecks. And of course, you do that for a while, but at some point, that Vicki Robbins philosophy kicks in, right? So you realize that you have such opportunity cost. You're giving up so much of your life for a job. When everybody believes our sequence of returns is no longer a problem, maybe then it becomes a problem again. So this is why I'm pointing this out. Be careful if you retire, and especially if you retire after a long bull market run, which is exactly the time when a lot of people become interested in FIRE, right? Because now their portfolio is really high and they think, now I can pull the plug. Well, this could be the most dangerous time to retire, and because if you have a recession and a bear market around the corner, that could sink your portfolio so badly that it may never recover in the end. Sometimes people call me kind of the Grinch of the FIRE community and say, oh, according to Karsten, nobody can ever retire. But it's actually, in this context, it's the other way around, right? So there are plenty of people that can retire much earlier than what the 4% rule proposed, even if the market is at all-time high. And then I'm the first to admit, right, if the market has already fallen by 20%, who knows, when people listen to this, we might be in 2025 or 2026, and the market might look very different. Then on top of that, you take that into account, that maybe the market is no longer at the all-time high and the CAPE is no longer at the all-time high or close to all-time high. So you should factor that all in, and you can probably increase your safe withdrawal rate.
Welcome to Catching Up to FI, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Jackie, and I'm also a late starter, and we're your host. We're here to help you on your journey to financial independence, no matter where you're starting.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to FI together.
Hello, and welcome back to Catching Up to FI. Jackie, how are you doing today? Are you ready for this, what we got going on today?
Yeah, I'm ready for this. I'm a little under the weather, but I got super excited when I knew that our friend Big Earn was joining us. He is just awesome, smartest guy I know. So this is going to be not just fun, but we're going to learn a whole lot. I can feel my brain growing already.
Before we get started, we got to make a few shout outs here. Our weekly shout out for a podcast is Everyday 5, Stories from People on the Path to Financial Independence with Megan Combs. She is awesome, a new podcaster, and want to encourage our audience to check her out. I also want to make a shout out to a couple of charities that are near and dear to my heart now, as my wife has recently recovered from a bout with breast cancer. And we would like you to consider the Susan G. Komen Breast Cancer Foundation. That's at www.komen.org. And then more locally and of interest to me here in Knoxville is an organization called Breast Connect, where survivors help survivors. And it's a Knoxville charity that has a great throughput of the money that's donated with very little overhead costs. So we encourage you to evaluate these charities through GuideStar that evaluates over 22 million nonprofits. And you can find the financials, admin costs, and it tells you the impact of the funds that are donated. So without further ado, let's introduce our big guest today. That's Karsten Jeske, also known as Big Earn, and he is big, 6'6" tall with a shoe size of 14. He's the founder of the popular blog Earn Early Retirement Now, where he writes on all topics related to personal finance, but is best known for his comprehensive series on safe withdrawal strategies. He's originally from Germany, but came to the U.S. in 1995. He believes that one of the most important topics in financial planning is how to transform an initial accumulation portfolio into a safe and sustainable retirement income stream. Karsten has an impressive resume. He has a master's and a doctorate in economics and holds the Chartered Financial Analyst designation. He has worked at the Federal Reserve Bank of Atlanta and BNY Mellon Asset Management and has taught economics at Emory University and UC Berkeley. His work has been published in leading economic and academic journals like the Journal of Political Economy and the Journal of Monetary Economics. After a long career in academia, government, and corporate America, Karsten retired early in 2018 in his 40s. He now lives in Washington State with his wife and daughter. So, Karsten, without further ado, welcome to Catching Up to FI.
Thanks for having me on the show.
Yay. Well, we're honored to have you.
Oh, thank you. All mine.
Yeah, I always say that some of the smartest people I know are in the FIRE community, and we got some real geniuses. And when I say that, I'm thinking about people like you. Like, we just heard about all the things that you've done, your degrees, your credentials, and all of that. And I feel like it's definitely a credit to the FIRE community that we have you as a resource. So we're glad to have you on our show. But I'd like to hear a little bit more about your FIRE journey. I heard about it a little bit, but I just love to hear kind of how that came about.
Yeah, so I grew up in a lower middle class family. So my father was a bus driver. My mom was a homemaker. We had no experience with the stock market or index funds or individual stocks. I had to pick that up on my own. And I came to the US for my university education. I came here for grad school at the University of Minnesota. And so I was already slightly interested in economics and finance, and then obviously got more into that field. And so growing up in Germany and kind of frugal, I've always lived below my means and kept my expenses at bay and had relatively high savings rates. So I always had in the back of my mind that I wanted to retire earlier than normal, say something like 50 or 55. But then obviously I was fortunate enough to have the nice run-ups in the stock market in the 2000s and 2010s. And so that accelerated the whole process. And at some point, you reach a savings target, and then you say, well, why don't I go another notch up and another notch up and another notch? Is that one more year syndrome, obviously? So I did that for a few years, and especially if you work in finance, right, you can make very good money. And then you get your year-end bonus, which is usually paid out early during the calendar year. And so you get that one bonus, and then you ask yourself, should I retire? No, oh no, let's do one more year, and let's get another one of these big paychecks. And of course, you do that for a while, but at some point, that Vicki Robbins philosophy kicks in, right? So you realize that you have such opportunity cost. You're giving up so much of your life for a job. And so when is enough? And well, at some point it was enough. I was thinking in 2016 already, in 2017, it might have been enough. But then in 2000, definitely I knew that it was time to go. And that's when I finally pulled the plug. So I came from a little bit more modest background. And I think I'm not the first person in my family to go to university, but the first person to do this whole stock index investing. And that was not something that was given to me from back home. I made that up and picked that up along the way.
Yeah, it sounds like during your accumulation phase, you were 100% stocks. And that's interesting and more common in the FIRE community. I think Jackie is 100% stocks. Now, I'm a little more conservative, but at the time you reached this exit to retirement, that's, I believe, when you became interested in the sequence of returns risk. Can you tell us about why you did and the fact that I guess you didn't find a lot of information about it out there?
Right. So first of all, sequence of return risk means that in retirement, think about you have a retirement of maybe 30, 40, 50 years long. It's not a question of if you're going to have a bear market during your retirement, right? It's a given that you will have some very bad recession, very bad bear market sometime along the way in your retirement. And it's almost a given that you have at least one, maybe multiple very bad bear markets during your retirement. So what determines your success in retirement is not so much if you have a bear market or how many you have, but very intriguingly, what matters more is when you have those bear markets. So in the worst possible scenario would be that you have a recession right out of the gates, right? So you imagine you had retired right at the peak of the stock market in 1929 or sometime in the 1960s, early 70s, even in 2000. You would have then experienced a bear market right during the first 2, 3, 4 years of your retirement. And now some of the forces that help you during your accumulation phase, they actually work against you. So for example, we all know this concept of dollar cost averaging, right? So dollar cost averaging is great. If the market is down and you're putting money in, you are now buying more shares for every dollar that you would put in, right? And so if you're in the accumulation phase, you can use this as almost like a psychological crutch to keep investing. Hey, now is a good time to invest because the market is down. Every dollar I put in buys me more shares. But this effect of the market being depressed and now you're taking money out now works against you because now you're taking more shares out of your portfolio. So it's certainly true that every recession, right, eventually recovers again. We've seen it. I mean, even the Great Depression, it recovered eventually. The 2000s, the global financial crisis, the pandemic crisis, even the 2022 bear market, you eventually recovered. But the question is, with your withdrawals, is it possible that you might have drawn down your portfolio so much that even with the eventual stock market recovery, your portfolio will never recover, even though the stock market recovers? And so that's what sequence of return risk means. It's not so much your average return during your retirement, it's when do the low return and high return periods line up. If you have low returns early on, that's really poison for your retirement. Whereas if you're lucky, in some sense, if you're lucky like me and you retire in 2018, and the bull market still has some legs and keeps running with a few wiggles in between. And even the pandemic bear market obviously was very deep, but it recovered very quickly. So for me personally, I had actually very, very good sequence of return risk, but it may not last and it may not be applicable to everybody. And then obviously, right, when everybody believes our sequence of return is no longer a problem, maybe then it becomes a problem again. So this is why I'm pointing this out. Be careful if you retire, and especially if you retire after a long bull market run, which is exactly the time when a lot of people become interested in FIRE, right? Because now their portfolio is really high and they think now I can pull the plug. Well, this could be the most dangerous time to retire. And because if you have a recession and a bear market around the corner, that could sink your portfolio so badly that it may never recover in the end.
So, Karsten, can I get clarification on something? So, you retired about a year before I did. I retired in 2019, and you mentioned that bear market during COVID, it was really short. So, around what length of time would you consider a bear market or recession where it would really start to have a negative impact and be not good for that sequence of return risk?
Yeah, so I can give you some examples. Right? So, for example, the bear market during the Great Depression, it started in 1929, in September, I believe, and the market dropped by some absolutely insane amount. I think it was somewhere around 80% in nominal terms, and the trough was in 1932. And then, so that means that's just the way down, right? So, and then obviously the market doesn't jump back from the low point back to a new all-time high. So it takes some time to come back. So from a sequence of return risk point of view, you have to cover not just the way down, but also the way up, which could sometimes take decades to recover, right, in the stock market. So that was definitely the case in the 1930s. I'll give you another example in 2000, right? In 2000, the market peak, I think the S&P was at about 1,500, a little bit over 1,500. The market did reach a new all-time high in 2007, but then it started tanking again, and it took until probably about 2012 to get even near its old level. And then especially because you also have to take into account inflation, right? So because the S&P 500 is quoted in nominal terms, so just because the stock market reaches old level, it means that, well, your expenses have gone up and your portfolio has melted away a little bit due to inflation. Well, there's also dividend yield maybe making up a little bit of that. But if you look at the month-end S&P 500 levels, even in 2007, you never reached, even taking dividends into account, you never reached a new all-time high until I think something like 2012, 2013. So it took over a decade to come back to a new all-time high, taking into account inflation and dividends. And then another very sinister, very sneaky kind of bear market was, so what happened during the 1970s, right? So during the 1970s, you also had some very bad sequence of return risk, but actually the cohorts, the retirement cohorts that would have been impacted the worst from the 1970s were some of the retirement cohorts from the 1960s. So, for example, anywhere between 64 and 68, if you had retired then, you didn't even see any very deep bear market around the corner. I think there was one short recession in the early 70s, I think 70 or 71, with a very mild bear market. But basically, your portfolio just went a little bit sideways and a little bit down because of your withdrawals. And then in 1973 and 74, you had the oil shocks, which was really bad for both stocks and bonds. And then continued 1979, 80, 81, and 82. You had some very bad market events that hurt both bonds and stocks. So you retired in something like 1968, and you didn't even realize until the late 70s that this is really, really bad. So it's kind of very slowly snuck up on you. And then, I mean, even some of the cohorts that actually in the end fared relatively well. So for example, if you had retired right before the oil shocks, and in, say, in late 1972, you would have made it with a 4% rule over 30 years with a diversified portfolio, but it would have been a very rough ride. So just because you made it in the end, but in between, you probably thought you're not going to make it because nobody knew how well stocks are going to perform post 1982, right? Because if you think about it, 1982 to essentially 2000 was one very long bull market with a few blips in between. Obviously 1987 with a very bad one-day drop. But these were all very short bear markets. So if you consider 1982 to 2000 just one long bull market, nobody would have known in 1982 that this is how strong the market is going to perform. So definitely some of the cohorts, even from the mid-60s, so halfway through their retirement, would have thought, this is the end of my retirement. So even though they might have made it in the end, and this is again all due to sequence of return risk. And there's no fixed number, right? So sometimes people say, if you made it through the first 5 years, then you got nothing to worry about. Well, but what if the first 5 years are basically the late 60s, early 70s, and then that's when the real bad stuff happens for another 10 years after that. So it's very hard to put really hard numbers on it. And in some way, I always make this point, right? It's almost like, have you ever seen one of these Mandelbrot pictures, right? Where this is this very elaborate shapes, and then you zoom in and then open more shapes. And the more you zoom in. So in some sense, your retirement and sequence of return risk is like that too, right? They always say, well, the first 5 years are really important from sequence of return risk. And now imagine you're 5 years into your retirement. Well, guess what? From that point on, again, the next 5 years are going to be really, really important from a sequence of return risk point of view. So it's this almost like the self-replicating picture where you zoom in and zoom in. The more you zoom in, the more intricate it gets. And a little bit like that happens with safe withdrawal rates and sequence of return. But again, I mean, if I had to put a number on it, right? I mean, for example, you can come up with the examples where you can say, well, now you definitely made it, right? So I retired in 2018. Our expenses have gone up roughly with inflation. And now more than 6 years into retirement, our portfolio is up probably around 2x in nominal terms, not in real terms. So definitely I have less to worry about running out of money. Of course, I still kind of sort of face sequence of return risk, right? Because going forward from now, right, if we have a bad recession close by, I will still make it. If the market keeps rallying, well, maybe I'll accumulate so much money that they might name a football stadium after me or something like that, right? And so in that sense, you always still face sequence of return risk, depending on what exactly you set as your target. Of course, you can say, well, at some point you made it if such and such, right? If you're 6 years into retirement and you have increased your portfolio by X%, even if we have another Great Depression now, I know that I'm not going to run out of money.
So obviously you were 100% stocks. When did you make the transition from accumulation to decumulation, and what adjustments did you make in your portfolio to sort of mitigate some of this?
Right. So in accumulation, I was pretty much 100% stocks. Since then, I have gone a little bit less risky. So if I look at my portfolio now, it looks like something like a 75-25. So 75% stocks, 25% less risky assets. So something like bonds and cash. And that's just the natural transition. If you're in retirement and you have 100% stocks, it's probably, look, if you have just overaccumulated vastly and you think you can get away with withdrawing only 2.5% or 3%, yeah, probably you can still get away with 100% stocks and keep it easy. But especially for people who say don't want to accumulate by 30 or 50%, and they actually want to retire when it's time to, say, use the 4% rule or use maybe 3.5% rule of thumb. It's usually better to have some diversifying assets, right? And it's exactly because of this issue. You have sequence of return risk. If you have a recession right around the corner, you would then have to withdraw from your equity portfolio that might be depreciated by 50%. Well, wouldn't it be nice if you had also some bonds lying around where you, in the worst possible case, right, you have something like an inflationary recession where your bonds are also down, but usually your bond portfolio is not going to fall by 50%, right? It would fall even in the 1970s. I don't think they fell by 50%. And in the best possible case, we have something like a deflationary recession, right? Economists call that a demand shock recession. You have something like in 2000 or 2008, where actually you have a recession, and that puts actually a dampening effect on prices. So prices go down, interest rates go down. If the Fed lowers interest rates, it's usually good for bonds. So not only do you have an asset that doesn't fall like stocks, but it might actually rally, right? So you had a bond market rally in 2000, in 2008, also during the pandemic. The only exception is in 2022, because we had a bit of an inflationary recession, or not even a recession, an inflationary bear market. Near recession, I would call it, was a little bit of weak economic growth, but never reached the recession levels. So, but most of the time, at least in the US, you have a actually very good diversifying asset in the form of bonds, because during the average recession, the Fed usually tries to assist the economy, lower interest rates, and that's going to be good for bonds, and that will help you with your retirement portfolio, because now you can actually take money out of your bond portfolio effectively, right? Because that's the asset class that went up, stocks went down, and so you have some hedge against a deep bear market. It's not foolproof, so it's not like you can suddenly raise your withdrawal rate from 3.5% to 5%, but it helps a little bit at the margin to have some diversifying assets, especially bonds. And so bonds would help you more during some of these low interest rate recessions. And then just cash, as in, say, something like a money market account or 3-month T-bills, would be obviously best if you believe that this is going to be an inflationary recession, because then you don't suffer that duration effect on the bond side. So if the Fed actually had to raise interest rates during the recession, which would be, it happened in the 1970s, right, early 80s. So that would be really poisonous for bonds. So then you would be better off with cash. But probably my expectation is the next recession is going to be, again, something like that puts a damper on prices. Interest rates go down. Bonds are going to be a great hedge with vis-a-vis your stock portfolio. So you need to have a little bit of diversification in retirement.
So, Karsten, when you're talking about having the flexibility with pulling from bonds or pulling from stocks, depending on which perform the best, so obviously a target date fund on the withdrawal side is not going to work, because if it's one fund with a mix of stocks and bonds, you don't get to choose. So they need to be separate at this point if you want to use the strategy of pull from stocks when it's the best time or pull from bonds.
So this is, I could talk a whole hour about that alone. So the problem with target date funds is that they may be then too conservative in retirement, especially for a lot of early retirees. And so I propose that, obviously, if you do the target date fund construction, quote unquote, yourself, right, DIY, then you can do this whole business of withdrawing from bonds. But in the defense of the target date funds, I would say, because they rebalance the portfolio, right? So they will sell bonds and buy stocks if the stock market is down enough. So if you sell from your portfolio, your net equity holdings might actually still be okay. It might be, money is fungible. It might actually do the same thing as if you did it DIY. And in some way, a target date fund, and again, there's one other reason why I don't recommend target date funds in retirement, but there's one other reason that I would give in defense of target date funds. At least they would do the rebalancing in a very robust and predetermined way. Right. Whereas sometimes you don't trust your emotions as a retiree. Right? For example, here's a retiree, right? The market is down 10%. And then they say, okay, I take all of my 25% bond portfolio and I put this all into the stock portfolio because now I can buy stocks at a discount. No, you're supposed to do this very strict, very rules based. So you don't want to do any kind of market timing schemes. And sometimes emotions get the best of us and we think we're smarter than the market. And we try to, this has to be the bottom of the market. Well, but guess what? The market drops another 30% from there. And then you potentially at the bottom, you pull your money out of stocks again and put it back into bonds right at the bottom of the stock market, right when the S&P 500 was at 666 points in March of 2009. So I think in some way, having this predetermined rebalancing rule, the way a target date fund would operate may not be so bad if you think that you can't do it yourself, if maybe your emotions get the best of you. But the real reason why I don't like target date funds so much is that the average target date funds keeps reducing your stock portfolio early in retirement. And there's actually some research, and I've written about it on my blog as parts 19 and 20 of my series. Some other very famous retirement researchers like CUtFI and Withdrawal came up with this term, the bond tent, where you do the glide path before retirement into more bonds and less stocks. But then during retirement, you shift slightly back into stocks again. And the reason for that is again a hedge. If you have a recession right around the corner out of the gates in your retirement, you would then put money out of the bond portfolio back into stocks, and you would then get a little bit of this dollar cost averaging through the trough of the bear market in case you do have a recession right out of the gates in retirement. Well, and guess what? If you don't, you leave a little bit of money on the table because you might have had too many bonds in your portfolio right around retirement. But guess what? I mean, you already won the game. You lose a little bit. So it's truly a hedge. It's an insurance where if things turn out really well, you lose a little bit and you can afford to lose it. But then if the economy and financial markets go down a lot, that's when you have a little bit of extra potential safe withdrawal. It's not going to completely hedge against sequence of return risk, but it's a very partial hedge against this sequence of return risk. And again, so this bond tent is the opposite of what the traditional target date fund does in retirement. So I always recommend if you have, say, target date funds, and usually people have these target date funds in 401k plans. If you have a 401k plan, you just take it out of the target date fund and then mix your own stock versus bond allocation in your 401k. If you can't do it in your 401k, you might have to roll it over into Fidelity or Vanguard and do it within a rollover IRA. But I personally don't care too much for traditional target date funds, certainly not in retirement. And then even before retirement, right, especially for early retirees, you can't really afford to do this very long, drawn-out 20-year path from 90% stocks to 55% stocks or whatever the most of these target date funds use. That starts way too early for most of the early retirees. And you should keep the 100% stocks much longer than what the average target date fund does.
I mean, people talk about reverse glide paths. I mean, you glide into retirement, and then I think what you're talking about is gliding back into stocks as another hedge against mitigating this sequence of return risk, right?
Right.
Okay. Well, why don't we take a quick break? And when we get back, we're going to talk a little bit more about one of your blog posts that we found to be very interesting, what the makers of the 4% rule don't want us to know. So we'll be right back.
Jackie, let's pause for a minute. And before we continue, let's share some words about one of this week's sponsors, Delete Me.
Yeah, the latest report from the Federal Trade Commission showed that in 2023, $10 billion was lost to consumer fraud, and $2.7 billion of that was lost to imposter scams.
Yeah, they've tried to scam me. They've scammed my mother. This is a real problem. So what do you do about it? Well, first off, just learning more about the tactics these scammers use can help us know what to look out for. But in a big way, I try to keep our family protected is to make sure that all of our personal information is removed from as many data broker websites as possible so that we're less enticing of a target.
Yeah, you'd be shocked at how many sites out there are sharing your address, phone number, birthday, email, and a lot more. But fortunately, you can get these data brokers to remove your information. But unfortunately, the process takes hours and hours to do it by yourself.
I know, because I tried to contact them, and only after spending 10 hours did I give up and start using Delete Me, our sponsor today. So take control of your data and keep your private life private by signing up for Delete Me. Now at a special discount for our listeners, just go to joindeleteme.com/catching up. That's joindeleteme.com/catching up. You'll find the link in our show notes. Okay, we're back talking with Karsten Jeske about now the 4% guideline, not the rule. There's terminology here that is very controversial in this. And then the makers of this rule are replete, and this rule was described back in the 1990s. So the first thing that you mentioned of the sort of the 10 things that they don't want us to know is something with regards to CAPE ratios, market valuations, on the success of withdrawal rate and variable withdrawal rates, and your shoe size, which is a little story there you have about this. So can you first define CAPE ratios and then how it relates to market valuations and our likelihood of success with our withdrawal rate?
Right. So, I mean, first of all, 4% rule. My problem is not so much with the 4% number. It's more with the term rule. And I think this is already why you set it up. It's a rule of thumb. It's a guideline. So it goes back to the research from Bill Bengen from the 1990s and the Trinity study that with the diversified portfolio, somewhere either between a 50-50, 50% stocks, 50% bonds, to maybe 75-25, most retirement cohorts would have done very well with the 4% initial withdrawal, adjust that for inflation every year, and it should have lasted you for about 30 years. And so the problem I have with that is it's not as useful as a rule as it is portrayed, right? So it's depending on your personal parameters, right? Are you a very young retiree? Are you, say, a middle-aged or still early, but maybe you retire in your 50s? You have very different parameters. For example, if you retire in your 50s, right? Remember, you have Social Security in the not too distant future. You might even, so for example, you retire at 55, you could draw Social Security 7 years into your retirement, or you could defer it all the way to age 70 and then get some potentially very generous benefits after only 15 years. So if you factor in future cash flows, right, which is very different from, say, the traditional retiree. The traditional retiree, very often, they get the Social Security and then they ask, how much of my portfolio am I going to withdraw over the next 30 years? And then that's completely separate from your Social Security calculations. For a lot of early retirees, we have this multi-stage retirement problem where we have cash flows in the future. We might have something like a house downsizing, right? You might have an $800,000 house and you might sell that at some future point and move into a $400,000 condo, and then that additional money goes into your portfolio. So all of that needs to be modeled, right? And with even just some idiosyncratic parameters, right, you could generate very bare bones safe withdrawal rates of maybe only 3.25%, say for somebody who retires at age 28, who doesn't have any additional cash flows from Social Security or pensions, and might make some extra money with some in the gig economy, but just purely from your portfolio, you probably can't withdraw much more than that in your potentially 60 or 60 plus year retirement. Or you could have people that are retiring in their 50s with the very large supplemental cash flows right around the corner, and you could have something like a 5 or 5.5 or 6% withdrawal rate, and you can sustain that initial withdrawal rate because you know that in the future when these additional cash flows come in, you're going to lower your withdrawals anyways. So the 4% rule is okay as a guideline if you think you're going to retire in 20 years and you want to get a rough estimate of how much money you need. You can do that rule of 25x or the 4% rule. But once you get closer to retirement, obviously you want to check, right? Am I in that 3.25 bucket or am I in that 6% withdrawal rate bucket? Because it makes a huge difference money-wise, right? Or so imagine you have $1 million portfolio, right, that could sustain either a $32,000 retirement or a $60,000 retirement. There's almost 100% range in between to go from 30s to the 60s. Or vice versa, right? If you have a fixed retirement target, so imagine somebody wants to retire on $100,000 a year, it makes a huge difference if this person needs, say, $1.6 million or $3.3 million, right, to sustain a 6% or a 3% safe withdrawal rate. And so it's just like we can't all wear shoe size 10, right? We can't all operate on that 4% rule, right? Because the 4% rule is like size 2, size 10 might work for the average American, but it won't work for me and it won't work for a lot of other people. So we should take into account, first of all, these idiosyncratic factors. And then on top of that, we should also take into account market valuations. And that's something where I kind of sort of had to shake my head that this is not talked about more often. I mean, there are some other people who talk about the Withdrawal has some research on that. But I'm just amazed that especially in the financial planning community, that this is not stressed more, right? Because depending on market valuations, obviously you should have different withdrawal rates, right? If you're right at the market peak with a very high CAPE ratio, right? That is the prime territory where you might have a bear market around the corner. Every single time the 4% rule failed, you had a S&P 500 market peak with a CAPE ratio that was elevated, both in absolute terms, so usually somewhere around 25 or more, and certainly also relative to its most recent history. And so whereas if the CAPE ratio is more moderate, you can obviously pull out a lot more money. And the reason for that is that, for example, if the market has already fallen by 20, 25, 30%, it's unlikely we're going to tag on another Great Depression onto this already 20 or 30% drop, right? So you should take into account that if the market has already fallen by X%, we're not calibrating our safe withdrawal rate to past worst case scenarios, because part of the worst case scenario has already materialized. So maybe instead of looking at, well, what would have been my safe withdrawal rate instead of 1929, well, maybe what would have been the safe withdrawal rate in 1930 or 1931, right after the market has already fallen. Or the same analogous, where would the market have been, say, in the 1970s when it was already down by 20 or 30%? So I wrote a blog post, right? The 4% rule works again. And I wrote that right around the market bottom in 2022, right? It was in October. And I said, look, the market has already fallen so much, right? You would be crazy to withdraw 4% now. Now you can actually raise it again. And there are two different ways, right? One is, well, I run my safe withdrawal rate toolkit and I look at, well, in the past, after we have already fallen by 20 or 25%, conditional on that, what would be the safe withdrawal rate? Not conditional on the market peak, but conditional on the market already down by X%. So you could do it that way. Or also there are some variable withdrawal rate rules that factor in the Shiller CAPE ratio. And so the same thing, because the Shiller CAPE ratio was actually in the low 20s at that time already. And so it looked a lot more sustainable to do something like maybe 4.25% or 4.5% withdrawal rate. So this is where I'm coming from. So we should customize safe withdrawal rates both on the individual level and then also take into account some market metrics. So, and which unfortunately right now we are recording this in early September. So market is again close to the all-time high again. So I would at this point obviously target again something like a more conservative withdrawal rate, but I mean still take into account your personal parameters for sure, especially say people who are your audience, right? They are not the people who want to retire at age 28, right? They're people who want to retire, say, in their 40s, 50s, early 60s. It's still very early, but because of these special individual parameters like pensions and Social Security, you might be able to get away with much more than 4%. I mean, you would be short selling yourself if you did only 4% in that situation.
Now, another way we can mitigate to come back to sequence of returns risk is sort of dynamic or tactical asset allocation. And there are portfolios that can help us reduce the volatility of our portfolio and actually increase our safe withdrawal rate. One of your colleagues, Frank Vasquez, is an advocate of this. And what would you say to the point that if you shift your portfolio to something potentially a little more complicated, like a risk parity portfolio, which we'll talk about in another episode, how does that help?
Okay, so first of all, when I worked for BNY Mellon, that was what we were doing. So we did some tactical asset allocation shifts. So we were not stock pickers. We looked at the big asset classes, U.S. stocks as modeled by S&P 500 futures, 10-year Treasury futures, and something like 3-month T-bills, and then shift back and forth tactically into what is attractive, what is unattractive, out of what is unattractive and into what is attractive. It is extremely difficult, and the average retail investor should probably not touch that. I think there are some people who claim that something like a momentum strategy has worked in the past. So basically what you do is you are into equities as long as they are rallying and as long as they are up. And then obviously you will never exactly catch the peak equity level. You will, but once you see there's a downward trend, then you sell equities and go into something like a diversifying asset, either bonds or cash. I have some sympathy for that kind of strategy. Personally, I find that probably the best thing you can do is have some kind of a mix where you take into account both signals from this trend following strategy, so the momentum strategy, but then also some valuation. And the nice thing about that is, so trend following versus valuation. So trend following, you're usually a little bit late around the turning points, right? Because you are selling when the market has already fallen quite a bit, and then you are buying it back after the market is already through the bear market trough and is starting increasing again. Whereas with the valuation strategy, you're usually a little bit early, right? Because you think that, well, equities are becoming really expensive now, so I'm selling a little bit. But you will usually sell well before the market peak. But then trend and valuation, you mix the two together, you might get it roughly right around the turning points. And I have some simulations. I'm probably going to write about that in my Safe Withdrawal Rate series. So this is getting super, super geeky, by the way. So I think there's some rationale for that. But I also think that that's something that probably the average retail investor is going to have trouble keeping organized and keeping disciplined. But if you are that person, yeah, you should definitely look into that. Personally, I don't believe in risk parity strategies because they don't do that, right? So basically they look at just purely, basically, again, for the geeks, is a variance covariance matrix, and then you try to assign certain weights, not in terms of portfolio weights, right? Because, for example, if you do something like a 60% stock, 40% bond portfolio, yeah, I mean, the space your stocks take in your portfolio, that's 60%. But amazingly, the risk that comes from that 60% stock portfolio still makes up 90% or more of that total portfolio variance. And so one way to deal with this issue is to bring in more uncorrelated assets and then assign certain weights that not on the portfolio percentage, but on the risk side. So I want to have this much risk coming from stocks, this much risk coming from bonds, this much risk coming from commodities. The problem with these risk parity strategies, and you can definitely press Frank on that, is that, I mean, obviously, a lot of people that run these risk parity strategies, they have a little bit of backward-looking bias. Right. So when I first encountered these risk parity strategies was in the 2000s, and they worked extremely well, right? Because the 2000s were a time when we had this really almost like a Goldilocks economy, right? Stocks were doing well coming out of the dot-com crisis. Bonds were doing well because yield did a bit of this bull market in commodities. And then if you had put together one of these risk parity portfolios, stocks, bonds, and commodities, And it doesn't even have to be parity, right? Because parity means that, well, you have three asset classes. It has to be exactly 1/3 risk from stocks, 1/3 and 1/3. There's nothing about parity. You can pick any target weights. It doesn't have to be exactly 1/3, 1/3, 1/3. But any kind of strategy that mixed between these three asset classes did pretty well. And the problem is that commodities then had a terrible bear market after the global financial crisis. So first of all, there's a lot of energy prices dropped. Then on top of that, the way you buy and hold energy and a lot of these commodities is not like, how are you going to buy an ETF that holds crude oil? It's not like you're going to put your crude oil in your backyard. Right? Crude oil has astronomical storage costs, right? And it's actually such bad storage costs. In 2020, crude oil prices went negative for a while. If you remember that, there was a crazy story where you actually had to pay to get rid of your excess crude oil because it was so expensive to store and nobody had any storage capacity left. And we had this overproduction. We couldn't drive down production fast enough. You actually had to pay somebody to take crude oil off your hands. So in any case, so the only way you can buy some of these commodities is through futures contracts, right? Because you don't hold the actual commodity. You basically just buy and sell promises to buy them at a future date, but then you never actually buy them and take delivery. And then there's some effects in futures markets and financial markets where this is actually a really, really bad proposition, where the return on your futures holding of crude oil are significantly worse than the crude oil spot price. So what you can show is over a certain time period, the crude oil price was $70 at the beginning and $70 at the end. So if you had kept your crude oil and there's no storage cost, you would have made a zero return. But with your future strategy of buying these futures contracts of purchasing crude oil at a future date and then selling the contract again when it gets close to coming due, you would have lost money spectacularly, something like at an 8 or 10% annualized rate. And the reason for that is that there's something that's called contango in the futures term structure, and I can't get into the details. But the point is that doing this via futures contracts, there is an additional cost. I mean, this is the additional cost on top of the ETF costs and everything. So it becomes very cumbersome, and it also becomes very costly to trade some of these contracts. And so I was never a big fan of that. And so some of these risk parity proponents, right, what they do is, well, during the 2010s, they didn't include commodities in their risk parity strategies because, well, looking backward, it would have been a terrible idea. Even though it was really good during the 2000s, became really terrible during the 2010s. And now they are including it again. So I think there's a little bit of backward-looking bias. So if somebody posts some returns and says, here's my risk parity strategy, and look how great the returns were, there is definitely a lot of backward-looking bias because they know what did best over the last 20 years. So lots of people, if they start at a certain time, they will exclude like energy commodities like oil and gas, and they will only include gold, right? Because gold actually, it doesn't quite have this contango problem. It also has a small storage cost, but it's not that bad. So anyways, I'm not a big fan of risk parity. I think there's backward-looking bias. And then I looked at the returns that Frank posts on his webpage, and the returns over the last few years were pretty atrocious. So I don't think that you beat just a diversified, say 60-40 or 75-25 portfolio. And so you wouldn't have beat that portfolio over the last few years, say from 2018 or something like that. And I also don't think that you really have much potential going forward of really generating the expected returns that you need for, say, a long early retirement, right? So, because usually your equity allocation is too low, and then you're mixing in a lot of very low return assets like commodities. I mean, gold obviously has had a pretty nice run, but the long-term return of gold is pretty much inflation plus maybe 1%. And if you extrapolate that forward, it's probably not enough, say, for a 40, 50, 60-year retirement. So I would still pin my hope to just a traditional portfolio, and this whole risk parity business seems a little bit like bells and whistles and a little bit like snake oil to me, that I don't think that that's going to work going forward. It hasn't worked over the last 10 years, and I have serious doubts that this will help going forward. And again, I mean, this is so risk parity. I don't think the way he sets this up is really a true tactical asset allocation, right? For example, if you want to seriously run a risk parity strategy, right? I need to see some Python code or MATLAB code where here's a risk, here's a variance covariance matrix, and then it has to spit out weights, and the weights have to pretty much constantly change over time, right? Because there have definitely been very significant changes in the correlation matrix, right? So for example, US treasuries were very, very negatively correlated with stocks, and now it's actually back to zero, potentially even slightly positive. So this is actually something that you have to almost run this, maybe not daily, but for sure monthly. You have to constantly adjust your target weights. I don't think he does that. So I don't think it is a very tactical asset allocation rule either. And by the way, there's nothing wrong with that, right? Because my 75-25 is not tactical either. But I think what he's doing is more a strategic asset allocation. And that's based on, well, this asset has more risk, so I'm going to assign this weight to that. I think it's more a strategic asset allocation. I wouldn't call risk parity the way Frank is doing it particularly tactical. So, but anyways, so the long-winded answer, I'm not a fan of risk parity.
Okay, well, that's interesting because we'll come back to this with an episode with Frank, and then we might go head-to-head with Karsten and Frank.
That'll be fun.
I'm sure Frank's going to listen to this, and he'll probably get in touch with you to talk about this. But we'll talk about risk parity. We'll define what it is, look for a future episode to do so. But you've heard it here. Karsten is not a fan. And he's outlined some of the reasons. We got into some weeds. This is going to be good for some of our geeky investors out there. We hope we didn't lose our average late starter investor. But let's get back to this list of, Jackie, what's the next question on why the 4% guideline, what you don't want to know?
Well, one of the things, honestly, that stood out to me was the one that, so I might be skipping around just a little bit, but the one that talks about the other things we should consider when we're talking about drawdown, like you mentioned pension, Social Security, side hustles, cash flows, and things like that. So I guess for that one, that was number 8. So we won't have to rely on the 4% rule ourselves, like because you have pension, side hustles, and things like that. So talk to us a little bit about that. I think that's really important to a lot of people as they think about how much they even have to touch their portfolio.
Right. So, and again, I'm not going to blame so much the researchers that came up with this 4% rule, right? So, for example, imagine you're Bill Bengen in the 1990s or the Trinity study, and you have to write a research paper on what is the sustainable withdrawal rate. You want to keep your retiree as generic as possible, right? You say that this is a 30-year retiree, has no additional cash flows, a flat withdrawal pattern, right? So you don't assume that later in retirement, maybe you're going to scale down, right? Because you're not traveling as much, or you might actually scale up because you might have nursing home, memory care, can be very expensive. So there are none of these bells and whistles. And of course, you don't want to have these bells and whistles because you want to keep it generic, because otherwise people are going to accuse you. Well, all of your results are due to this assumption or that assumption. So you want to have as little in terms of assumptions for these idiosyncratic factors as possible. But the problem is that, well, we are all idiosyncratic little households, and we all have our additional factors that we should take into account, right? We have potentially side hustles, right? When I retired, I still had 3 years of extra, not salary, but I had deferred bonuses that vested after 3 more years. So in 2019, 20, and 21, I still got a pretty sizable sum of money. And so I didn't have to touch my investments very much. I would have a company pension, a small one, but I wouldn't want to lose it. I can draw that at age 55. My wife and I, we want to do Social Security, and we do that Social Security maximization where, because I'm a little bit older than my wife, so I will wait until age 70 and she can claim at age 62. And then if I pass away, which is just how demographic works. I might be the first to go, then she will take over my benefits. So if we take all of that into account, yes, you can absolutely push your safe withdrawal rate a little bit higher. Now, it's not like you can go from the bare bones, from maybe 3.5% or 3.25%. You can't just suddenly go to 6%, but usually it makes a meaningful difference. And then again, always keep in mind, right, that small changes in your withdrawal rate, right, they may seem small. So imagine you can go up from 3.5 to 4%. It's not a 0.5% difference, right? It's 0.5% of your nest egg, which could be a very large amount, right? From 3.5 to 4 is actually more than a 10% increase in your retirement budget. So that makes a meaningful difference. And then again, I've done case studies for folks in the FIRE community, and it is always the same pattern, right? If you are already in your 40s or 50s and you have these large supplemental payments in the not too distant future, you may push this a little bit higher. You might actually go to 5% or above 5%. Then again, so imagine you have $10 million in your portfolio. Well, maybe that $3,000 Social Security benefit, that doesn't make a huge difference in terms of the percentages, right? But for most people, right, that's average Americans that have maybe a low seven-figure portfolio, and you have some maybe $3,000 a month for one spouse and maybe another $1,500 for another spouse, that adds up to quite substantial amounts. And then again, it's not from right at the beginning. It might be 10, 15, 20 years down the road. But even then, it may make quite a big difference. It might sometimes make a difference of 1 percentage point, right? And again, so 1 percentage point going from 4 to 5%, that's a 25% increase in your budget. So we should all look at this very carefully. And then especially your audience, right? Doing the FIRE a little bit later, you are predestined to do your math more carefully, because you may actually underselling yourself at 4%, even if the market is at all-time high. Because again, you have longer work history, right? You might get higher Social Security benefits than the average super early retiree, and those Social Security benefits might be right around the corner. So absolutely, you want to do more careful analysis, because if you're saving until you reach 25x, you might be 67 or 70 at that time. You might get to FIRE much earlier if you do your math right. So, because sometimes people call me kind of the Grinch of the FIRE community and say, oh, according to Karsten, nobody can ever retire. But it's actually, in this context, it's the other way around, right? So there are plenty of people that can retire much earlier than what the 4% rule proposed, even if the market is at all-time high. And then I'm the first to admit, right, if the market has already fallen by 20%, who knows, when people listen to this, we might be in 2025 or 2026, and the market might look very different. Then on top of that, you take that into account, that maybe the market is no longer at the all-time high and the CAPE is no longer at the all-time high or close to all-time high. So you should factor that all in, and you can probably increase your safe withdrawal rate.
So that's good news for our community, right? We may undersell ourselves, according to Karsten, and the Grinch gives us hope. One of the things you mentioned in this list, which I really found interesting, is there are things that reduce the 4% rule. We ignore several things, and that we have to think of when we look at this guideline of the 4%. What are the things that we ignore that reduce this already inherently?
Yeah, so I mean, for example, expense ratios, right? We probably not the biggest issue anymore, right? Because for most of us, if we are with Fidelity or Vanguard or Schwab, we have very low expense ratios. But yeah, I mean, so for example, if you have a money manager that manages your portfolio and charges an AUM fee of 1% or 1.5%, unless this person is actually so good that they generate this 1% or 1.5% as extra return through, say, stock picking or market timing, which again, I think most people probably wouldn't succeed in that. But yeah, I suppose you have some other financial fees, right, or taxes that would reduce what you could actually consume. So you might withdraw 4%, but you may not get to consume everything because you have to cover your tax bill too. It's not really a huge concern for most, right? Because if you play this right, and you stay, say, in the 10 to 12% federal marginal tax bracket, and your capital gains would be taxed at 0% in that range. So you could actually make something like $120,000 or $130,000. If it's all capital gains or mostly capital gains, you still pay zero federal tax. You might live in a state that has zero state income tax, Washington, Tennessee, right? And maybe tax is not the biggest concern for most people. It's not the biggest concern for me. But yeah, I mean, obviously, you could live in a traditional high tax state where you have almost like I think Georgia has a pretty quickly you get to the highest marginal tax rate of something like 5 or 6%. There's some other states like Oregon is also quite greedy. California is actually, if you stay within a certain budget, the marginal tax rates are actually quite low. It's the really astronomical tax rates at 10%, 11%, I think 13% now. They only start for some really, really high incomes. But yeah, I mean, it's obviously you have to keep in mind that you also have to pay taxes. And again, there's probably a whole other episode that you want to bring some experts on that. So how to do the Roth conversions and how to spread out that need to take money out of your IRAs. And so that's I'm not a tax expert, so I don't really talk about that so often. But there are obviously some ways to mitigate some of this tax hit. But yeah, I mean, most people will probably have something like an effective tax rate somewhere between 3 and 10% in retirement. And yeah, I mean, if you withdraw 4%, well, that's really only maybe somewhere between 3.6 and 3.9% after taxes. So keep that in mind. Even if you are a DIY investor, you don't have any AUM fees, you have very, very low expense ratios, there's still a little bit of a tax drag.
Yeah, well, we're going to get to the rest of these. And so, Karsten, what about the flexibility? You say that that's overrated.
Right. So again, I never say that it's useless, right? I mean, I'm a flexible guy too. So which means that if my current spending level suddenly becomes unsustainable because my portfolio is down by 50% and I have to take down my spending, I will definitely do that. And so I'm totally in favor of that. So nobody would be crazy enough, right? So imagine your portfolio is down and you pretend nothing ever happened. Right. So the problem I have with this whole flexibility mantra is that people say, well, you have to be flexible only for as long as the recession or the bear market lasts. And then they look at some kind of market stats and you find that the average bear market only is, it could be less than a year. I think some of the longest bear markets was probably 1929 to 1932. So that's 3 years, actually a little bit less than 3 years. I think 2 3/4 years. So you have to be flexible only for as long as the bear market lasts. And that's actually not true, right? Because you, at the bottom of the bear market, your portfolio, that's actually the bottom of the portfolio, right? So the time it takes your portfolio to recover, right, and to a new all-time high or to where it was when you first retired, that may take, again, and we talked about that earlier in the show, that can take years and years, maybe even decades. So yes, I'm all in favor of flexibility, but sometimes people underestimate for how long you have to be flexible, right? And sometimes people might be then too aggressive, right? They say, well, 4% is the safe withdrawal rate. Well, but guess what? I'm going to do 6%, and then I'll just be flexible if something goes wrong. And well, if you start at 6%, right? So, and 4% is already a little bit shaky, right? You already know, right? So imagine you have $1 million portfolio, you do initial withdrawal, $60,000. If 40% risks running out of money, right? So that means you can't be at 60. You can't just go from 60 then down to 40, right? Because you have already withdrawn more than 40 and 40 will run out of money. So you have to actually go way below 40 to make up for the initial excess withdrawals. So people have to realize that flexibility doesn't mean you're just skipping the cafe lattes at Starbucks. I mean, there's potentially some extremely painful reductions in your spending, potentially say a 50% cut in your spending. So you take all of the discretionary budget out and you only spend on the mandatory budget. And then that can also last for a very long time. And again, I did some simulations on that. And yeah, I found some of these flexibility rules. First 15 years out of your retirement, 12 years, you had to cut your spending by 50%. And that seems a little bit excessive to me. But I absolutely agree that if you have some flexibility to, say, cut your expenses for 2 or 3 years by, say, 25%, you can also model that with my simulation tool and then see what kind of a difference it does in your safe withdrawal rate. And usually it doesn't make a huge difference, right? I mean, if your old safe withdrawal rate was 3.5%, maybe you make it to 3.6%, which is good, but you can't just miraculously say, oh, due to flexibility, I can suddenly increase my safe withdrawal rate astronomically. It's not going to work that way, and it's just purely mathematically, right? So it's like squeezing a balloon, right? If you increase your spending early on, you have to decrease it later, and you can't just make up for these excess withdrawals early on with just a few scraping together pennies and a few quarters here and there. It has to be some very substantial cut in spending, and it has to be very long. And some of these flexibility rules, if you actually simulate them and you expose these rules to some past recessions like the 1930s or the 1960s and 70s, or even the early 2000s, it would be quite painful. And then on top of that, right, you also potentially create some false alarms, right? So as one of the best examples is, as I mentioned that early, some of the cohorts in the early 1970s, they would have made it through the 1970s, the inflationary shocks and the recessions and the Paul Volcker and interest rates going up to double digits and almost 20%. You would have made it in the end, but of course you didn't know it in 1982. So this flexibility, first of all, it's quite painful, and then it also creates these false alarms, right? So you have false positives where you have to reduce your spending, even though it wasn't necessary in hindsight. So again, I don't want to poo-poo it too much. I think I'm flexible, and we should all be flexible, but it's not a panacea. So I think if you are flexible, try to model it and see how much of a difference it makes. And then if anybody tells you, but you can withdraw more than that, well, that means you also have to be more flexible for much deeper spending cuts or much longer spending cuts. So
Karsten, now we see why you dedicated a whole big chunk of your blog to safe withdrawal rates, and you are I consider the authority when it comes to that. So we definitely will drop in the show notes this full article, your whole landing page for safe withdrawal rates and sequence of return risk. But is there anything else that you want to make sure that we convey to our listeners about safe withdrawal rates?
Yeah, so I mean, if you just do the landing page, which is just earlyretirementnow.com/SWR, and over there's a little bit of a write-up of all the different posts I've written. So every post has something like 1 or 2 sentences where it fits in. Don't go through the list from part 1 to 61 in that order, because, right, I mean, over time, there's all sorts of topics come into my mind, and they come in a very crazy and random order. If you read it in that order, it might not be very enjoyable. But yeah, I mean, if you look at just that landing page and see if anything strikes your interest, then read more, or just take the summary and be happy with the summary, and be happy that you don't have to read the whole blog post. Some of them are very long, say something like 3,000, 4,000, 5,000 words. Yeah, and then, I mean, just in general, my blog is actually only maybe 1/4 of my blog posts are about the safe withdrawal rate series. I also write about some other topics that just come into my mind. Earlier this year, there were people kept bugging me about 2 papers that were written. One is, should we have 100% equities and be done with it? No bond diversification. So I wrote a response to that paper. And then there was another paper that was critiquing this whole idea, stocks for the long run. And so I also wrote a comment on that. So if you find these on my blog, I think they were written something like in February or March or April 2024. So they got a lot of lot of comments. So I write about other finance related topics, and then also just some other not so financial topics, right? So recently I had a blog post, does early retirement reduce my life expectancy, right? Because there's some research on that topic, and I give my 2 cents on that. So
Does it reduce? Because I want to know. You want to know, Bill, too, right?
Because there is some academic research that claims that, but I point out a few, and Bill probably knows some of that stuff because you're in the medical field, and then some of the people that are in the intersection of medical and statistics, they write papers about topics like that. And so I point out some of the data and modeling issues. And as I personally still cross my fingers that early retirement increases my life expectancy. And my idea is that even if it doesn't, right, at least I think the quality increased, even if the quantity, the number of years, if I lose maybe a few months at the end, that's fine if I enjoy my life now. So,
well, you also have for folks in our audience a toolkit or a spreadsheet that they can use. Can you tell us about that?
Yeah, so that is also part of that Safe Withdrawal Rate series. It's part 28, where I go through the mechanics of that, and it has a link to that sheet. And if that's all really overwhelming, there are actually 2 very nice bloggers, the 2 sides of FI. Do you know Eric and Jason? Maybe you should have a link to their blog too. So they did, I think, 2 YouTube videos where they go through the toolkit and say, hey, it looks really intimidating, but here, I mean, you can pick this up in 20, 25, 30 minutes and run your own personalized safe withdrawal rate simulations. And it's actually relatively easy. And if they hadn't done it, I would have done that little bit of a walkthrough video at some point, but they did it already for me, so I don't have to do it. So that link to their YouTube channel and that video is also in that.
But we're about late starters, and I'd like to close today with any particular tips that we haven't talked about today that you might have for our late starter audience that are a little bit stressed out about not having saved, not having accumulated. And there are any top 3 things that they can do or look forward to even as late starters?
Right. So, I mean, first of all, you have to get started, right? You have to get started in investing. And I think there are always 2 barriers, right? If the market is rallying, people say that, okay, I don't want to put money in now because the market is too high. If the market is down, they will say, oh, I want to put my money in now because the market is down. So you almost have to rewire your brain. And so I always did that. If the market is rallying, I said, yep, momentum works. If the market has gone up the last year, chances are it will go up. I mean, it's statistically very significant. If the market goes up, there are chances that it will keep going up. And if the economy keeps expanding, there are chances that it will keep expanding. So ride the momentum train if we're at the all-time peak. And then if the market is down, then you just think like a value investor and you say, well, valuation looks really good. Now I can buy stocks at a discount. So that kept me, I mean, first of all, it got me started. Because my work career started in 2000, right at the peak of the dot-com market peak, and then it crashed. So the timing when you start investing is really not that important. In retirement, it is, whether it's a market peak or not. Starting to invest, you don't really have to worry about valuations. Just start it and keep it going. And if you need some kind of a psychological crutch, do that momentum and valuation. The market goes up, keep investing because there's momentum. If the market is down, keep investing because valuations are attractive, and keep that going. And automate your finances and also enjoy the ride, right? So, I mean, I always felt that it was not worth it to cut yourself short and live like a miser. I would rather retire a year or 2 or 3 later and actually enjoy the ride. Hedges this risk that you fall off the wagon and hate what you're doing. I've seen people from the FIRE community go through that if you cut yourself short too much. So I can see at some of these, say, FI meetings, people try to outdo each other, and I have an 80% savings rate and I have a 75% savings rate. Oh my goodness, I have only 50%. And yeah, I mean, if that restricts you too much, just do 30 or 40%, right? I mean, you will eventually get there. And it's better than not starting at all. So
that works out on the downside too, when people reach fire and then they have a hard time spending and they keep their spending low. So the people that save the most often spend the least and have a hard time enjoying life on both sides. They get a little whiplash or whipsawed by saving and then spending.
Yeah.
And we late starters don't have a problem with that, because I spent and enjoyed life that way. And actually, towards the end, I've cut back on work. So in my free time, I do this podcast with Jackie and have great guests like you. So these are the things I couldn't do if I was killing it on the earning, saving, investing. So it may extend my runway, but I'm enjoying the ride a little more. And thank you, Karsten, for joining us today. We're going to have absolutely have you back to talk about other topics. We've covered a lot of ground today, but your knowledge base is almost infinite, and we want to tap into it in the future. Right, Jackie?
Yeah. And Karsten, we talked about your blog. Where else can people find you? Is that the best place?
Yeah, blog is probably the best. I'm on Twitter, and I don't really do much on Facebook. Sometimes people DM me on Facebook, and then I find it after 2 months. And so the blog is probably the best. And Twitter, Twitter is if you want to DM me, Twitter is probably the best.
Okay, and the blog is Early Retirement Now. We will see you on .com, and we'll see you on Twitter. But like you mentioned, I want to highlight this, is that you have a ton of other topics on your blog. But I have known you. I always thought of you as a safe withdrawal rate guy.
Sure.
But as I was digging in for the show, you've got a ton of other great topics as well.
Yeah.
Well, Karsten, thank you for joining us today. We look forward to talking to you in the future. And just thanks for all you do for the FIRE movement. We really appreciate it.
Yeah, thank you. Thanks for having me.
So, Bill, as you know, we cannot do this show without our amazing staff and the people that help us put this on. So our social media is Diana Falk, our editor, Fritz Bassard, and show notes are done by Sarah von Sternberg. We love them, and they keep us going.
Yeah, I mean, this show wouldn't have the quality it has without our folks, our peeps. And we'd also like to give you a few calls to action for the show. We love our community, and we hope you love us back. If you want to support the show and what we're doing, you can do that at Buy Me a Coffee, which is a platform that allows you to virtually say thank you if you get value from our content. The link is in the show notes, or you can head over to our website at CatchingUpToFi.com and click on the Support the Podcast tab at the top right. We hope you've enjoyed this episode of Catching Up to FI. We would appreciate it if you could leave us a 5-star review so that our message can reach others.
While we are financial educators, and I'm a financial professional that loves to teach, our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
We'll see you next time on Catching Up to FI.